Good morning, everyone. I hope all of you are doing well and are fresh to continue with India's 36. Just let me quickly know at what time did you get up today so we get to understand how much are you preparing early in the morning because of these classes. Good morning once again to everyone, and let's start from where we left yesterday. In the meanwhile, just if you can let me know at what time did you get up today. Okay. So we'll have a look at this particular illustration. I have already shared the detailed solution with all of you in the group. But still, I want to discuss this question quickly because it's a very comprehensive question. And if you're able to handle these kind of questions, then it would be easy for you in the examination. So this particular illustration 21 in our IndigoLearn's material. Area Limited is a manufacturing company which deals in manufacturing of cold drinks and beverage. It has various plants located across the country. There is machinery A in Baroda plant which is used for the purpose of bottling, and there is one more machinery which is machinery B clubbed with machinery A. Now, your machinery A, machinery B. Machinery A can individually have an output and sold independently in the market. So, machinery A you can independently sell it in the market, but machinery B cannot be sold in isolation without clubbing with machine A. So, machine B cannot generate cash flows independently. Now, when it cannot generate output independently, what you do is you aggregate different machines and you create something called as a cash generating unit. So the company considered this group of assets as cash generating unit. Now in examination, all of this information is not very relevant. Okay, so what you need to understand is how quickly you can just go through the question and say, okay, this is not relevant to me. I will not consider this particular part. And has an inventory amounting to 2 lakh and goodwill amounting to rupees 1.5 lakhs is included in the CGU. So in the CGU you have machine A, machine B, and you have goodwill and inventory. Inventory, friends, is covered under Ind AS 2, so you'll calculate or you'll value it as per Ind AS 2 only. Machine A was purchased for rupees 10 lakhs and has a residual value is 50,000. Machinery B was purchased on 1st of April of 15 for 5 lakhs with no residual value. The useful life of both the machine is 10 years. So now the reason they have given this information is they have purchased this some years back. We need to calculate what would be the depreciation till this particular date so that we can calculate the carrying amount. Right? Then the useful life of machine A and machine B is 10 years. The company expects following cash flows in the next 5 years pertaining to machine A. So for machine A, independently you have the cash flows and they have given cash flows 151 and so on, excluding residual value. This cash flow you will discount and you will arrive at the present value, which gives you the value in use. On 31st March of year 18, the professional valuers have estimated that the current market value of machinery A is 7 lakhs. So values means what? The fair value. The valuation fee was rupees 1 lakh. There is a need to dismantle the machinery before delivering it to the buyer. Dismantling cost is 1.5 lakhs. Specialized packing cost would be 25,000 and legal fee would be 75,000. Now here they have given us different information related to the cost. Okay. Now what are those different elements? One is the fair value. Okay, so fair value they have calculated 7 lakhs. Now the valuation fee is 1 lakh. Now is the valuation fee cost of disposal? That is what we need to understand. Whether the valuation fee is cost of disposal. Now the valuation fee that we see here is already incurred. That is not a cost that you will be incurring to sell the machinery. Okay, that's not the cost you will be incurring to sell the machinery. So valuation fee will not be considered as a part of your fair value less cost to sell, because you have already incurred, whether or not you sell the machinery, you will be, or you have already incurred that cost, that will not be considered. But the dismantling cost, the packaging cost, and the legal fees you will consider. So 7 lakhs minus 1.5 and 2.5, when you do 7 minus 7 minus 1.5 and 1, that is 2.5. 7 minus 2.5 is 4.5. This 4.5 is my fair value less cost to sell. The inventory has been valued in accordance with Ind AS 2. So one thing you have to keep in mind is you will not again go and say inventory is impaired, because as per Ind AS 2 you have already stated it at net realizable value. That is your estimated selling price minus cost of completion and selling. The recoverable value of the CGU is rupees 10 lakhs as on 31st March of year 18. In the next, so on 31st March of year 18, CGU has a recoverable value of 10 lakhs. In the next year, the company has done the assessment of recoverability of the CGU and found that the value of the CGU is 11 lakhs. The recoverable value of machine A is 450 and combined of value of machine A and B is 760 on 31st March. Compute the impairment loss and carrying amount of each asset after charging impairment loss for the year ended 31st March 2018. Compute the prospective depreciation for 18-19 and compute the carrying value as on 31st March of year 19. So let me just take up the solution. Quick discussion. The detailed solution I have already shared with you in the group, which you can have a look at it. So first thing, or the first step that we need to do or follow is calculating the carrying amount of individual machine as on 31st March of year 18. So that is very simple. What we have done in Ind AS 16 will follow the same principles, right? What is the cost? What is the residual value? What is the difference between that two? And what is the cost minus residual value divided by the number of years? You will get depreciation per year and how many number of years have been completed. One was purchased in 13, so 5 years have been completed. One was purchased in 15, so 3 years have been completed. You calculate the carrying amount, that is 525 and 350, that is for individual machinery. Then we calculate the recoverable amount for machine A. Recoverable amount is what? It is higher of fair value less cost to sell, that is one part, and the other one is value in use. So value in use is nothing but your present value, or so you can just take the cash flows, multiply it with the present value factor, you get the present value of cash flows, and fair value less cost of disposal, we said it is 450. We just calculated that orally. So 489 and 450. Recoverable amount is higher of fair value less cost to dispose and value in use, which is 489 770. 489 770. Carrying amount of machine A as on 31st March of year 18 is 525. So the impairment loss is 35 to 30. So because you are able to independently calculate the amount of machine A, that is the recoverable amount, you calculate the impairment loss of machine A, which is 35 to 30. Now after that you have to look at the CGU. Now when you look at the CGU, so the order is calculate the carrying amount as per respective standard. Then if that specific asset, you can test for impairment of that and calculate the amount for that. So for machine A, now the carrying amount for our calculation becomes 489 770 after the impairment loss. Machine B 350, inventory 2 and goodwill 150. Carrying amount of CGU is 1189 770. Carrying amount of CGU is 1189 770. Recoverable amount is 10 lakhs. Recoverable amount as given in the question is 10 lakhs. So impairment loss is 189. First thing what we will do, we'll write off goodwill 115. Now normally what we have understood is that this particular balance amount of 39,770 should be allocated to other assets, in the ratio of their carrying amount. Now machine A is already stated at its recoverable amount 489,770. So you cannot further go ahead and impair that particular asset. So whatever is impairment loss, you have to allocate amongst the remaining assets. Now remaining assets are what? Machine B and inventory. Machine B inventory, valuing as per Ind AS 2, you don't need to impair that again. So the entire impairment loss will allocate to machine B, and 39,770 gets allocated to machine B. So goodwill becomes 0 and inventory remains same. Machine A cannot go below its recoverable amount, and the balance impairment loss is taken to machine B, right? So that is how you will calculate. Then subsequent depreciation will be based on the revised carrying amount minus the estimated residual value over the remaining useful life. So like that you can calculate. Then carrying amount, assuming inventory is the same, you get the carrying amount of CGU at 867. Recoverable amount is 11 lakhs. Now this excess is, you have to see whether reversal would be possible. How do we reverse that? That we'll understand as we discuss the theory part. Okay, so till here, do you have any questions? Please let me know. Yes or no. If you have understood, yes. Otherwise, if you have any questions, please let me know, and then we will continue. Okay, thanks Saisha for the confirmation. Okay, the subsequent part relates to reversal, which we'll discuss, and the entire illustration I have already shared with you. Important because you can actually use it for the revision kind of thing, the last minute revision if you want to do. This is one of the questions you should be having a look at, because quite comprehensive, and you will know how to calculate each of the steps. Now moving on, so till yesterday we discussed about impairment loss to CGU, specific aspects around goodwill, very important discussions on how do we impair goodwill and how do we allocate goodwill. So a lot of time what happens is goodwill is generated or goodwill is created when there is a business combination. Now when you acquire a business, or when you do a business combination, when you acquire a business, how should we allocate goodwill? Should we allocate it to one division? Should we allocate it to one branch? All of that understanding we need to have absolute clarity for. Okay, so when you acquire goodwill, for example, one company acquires another company. Say for example, Reliance acquires ITC. ITC has multiple divisions. Now the goodwill that is being acquired, how should we allocate that goodwill? That is what we are going to understand. Now, what the standard says is goodwill acquired in a business combination. Goodwill acquired in a business combination from the acquisition date should be allocated to each of the acquirer's CGU or group of CGUs that are expected to benefit from the synergies of the combination on non-arbitrary basis, whether or not the acquiree had assigned the goodwill to those groups of units or assets or liabilities, right? So what does it mean? Basically, let's say I have acquired another company. When I'm acquiring that company, I got some goodwill, let us say 100 crores. So that 100 crores of goodwill I'll allocate to my existing units or the new CGUs that I've acquired on a non-arbitrary basis. I will see that goodwill gives me benefit to which of the divisions, my existing divisions plus new divisions, whichever division will get benefit of that goodwill, to those divisions I will allocate goodwill. Right. Now, the CGU or group of CGU to which the goodwill should be allocated should represent the lowest level within the entity at which the goodwill is monitored for internal management purpose. So it should be the lowest level, means at which level does the management monitor goodwill for internal reporting purpose, and should not be larger than an operating segment as per Ind AS 108. So as per Ind AS 108, what is the operating segment? Okay, it should not be larger. So the CGU to which you are allocating goodwill should not be bigger than an operating segment as per Ind AS 108. Okay. Now, please remember, goodwill is not amortized. Goodwill is not amortized. So when goodwill is not amortized, you have to test for impairment of goodwill on an at least on an annual basis. That is how you have to consider. Now, in this this part is again important, where you have to follow a two-step model. That is, if a goodwill is allocated to a group of CGUs, but it cannot be allocated to an individual CGU, then first you will test individual CGU for impairment before you test the overall CGU. So the order of impairment testing in the example just now that we saw also, first test at the lowest level possible. So we tested for machine A. Here also, let us say you have 5 CGUs. You have 5 CGUs. Goodwill cannot be allocated to individual CGUs on a non-arbitrary basis. In that case, what you will do? Individual CGU, first you will test for impairment, then combine all the CGUs, add goodwill to it, and then test for impairment. Same logic we apply for corporate assets also. Corporate assets you will allocate to individual CGUs and test them for impairment. Now, when you talk about corporate asset, where we have corporate offices, or the head offices, or some other assets which have to be allocated to respective CGU, then you have to see, can we allocate it to the CGU on a reasonable and consistent basis? Means, do we have some basis? Maybe sometimes number of employees working for specific CGUs, or maybe sometime number of hours dedicated. Some aspect can we decide, or some basis can we decide to allocate the corporate asset. For example, there is a corporate office. In that corporate office, 3 floors are working for one CGU, 2 floors are working for another CGU. So 3 floors related asset you will allocate to one CGU, 2 floors related to other CGU. Right. Now, how do we do it? You will take the total amount of CGU with the corporate asset. In the example that we saw yesterday, take all the assets of the CGU plus the corporate asset and test for impairment. And remember, if there is an impairment loss, first we'll write off goodwill. And remaining assets we will allocate to all the assets, including the corporate asset, on the pro rata basis. Means whatever is the carrying amount of individual assets, in that ratio we will allocate. But first we'll allocate it to goodwill. If we cannot allocate corporate assets to CGU on a reasonable basis, means we don't have a basis to allocate corporate assets to respective CGU, then in what case what we will do? We will compare the carrying amount of CGU without the corporate asset with the recoverable amount. So I have a CGU, I have a corporate asset. That corporate asset works for 3 or 4 CGUs, but I cannot allocate, or I don't have a basis to allocate these corporate assets to those CGUs, right? Now, when I cannot allocate, or when I do not have a basis for allocation, what I will do is, first I will take CGU for their impairment. Then, if there is any impairment loss, first apply to goodwill and to remaining asset. First apply to goodwill and to remaining asset. Then I will see how many CGUs can I group together and add the corporate asset, and again I will calculate impairment loss for those corporate assets along with the CGU. So if I'll just have to give you an example for this. So say for example I have CGU1, CGU2, and there is a corporate asset. The corporate asset cannot be allocated to CGU1 or CGU2 on a reasonable and consistent basis. Then what I will do, I will check the carrying amount and I will check the recoverable value for both of this. Then I will see how much is the impairment. That impairment I will allocate to the respective assets of CGU1 and CGU2. Okay. Then what I will do is I will take CGU1 plus CGU2 plus corporate asset, and then again check the carrying amount versus recoverable amount, and then I will calculate the impairment loss. Is that clear? Okay, I'm taking an illustration so that will help you understand. Okay, so let's have a look at this example with numbers that will help you understand. ABC has three cash generating units A, B, and C, the carrying amounts of which are given below. So cash generating unit A, B, and C, 500, 750, and 1100, and carrying amount is in rupees crores. Remaining useful life 10 years, 20 years, and 20 years. ABC Limited also has two corporate assets having a remaining useful life of 20 years. Corporate asset X, corporate asset Y. Carrying amount 600, 200. The carrying amount of X can be allocated on a reasonable basis to the individual cash generating unit. So whatever is X, you can allocate it on a pro rata basis to the respective CGU. The carrying amount of Y cannot be allocated on a reasonable basis to individual cash generating units. So X can be allocated, Y cannot be allocated. Recoverable amount is given below: cash generating unit A, B, and C. So you have cash generating unit A, B, and C, and you have ABC Limited entirely. The cash generating the recoverable amount is 3200. Calculate the impairment loss, if any, and ignore the decimals in your calculation. Okay. So now share the Excel. Now, here we have in the question the carrying amount of each of the asset 500 given in the question, 500 given in the question, 500 given in the question, 750 given in the question, 1100 given in the question. So these three carrying amounts are given in the question to us. Now, what the question says is X can be allocated to A, B and C, but Y cannot be allocated. X can be allocated, Y cannot be allocated. Now, one thing what you have to understand here is the useful life, the remaining useful life of A is only 10 years, B is 20 years and C is 20 years. Now, this entire 600 I cannot allocate to A, B and C just on the basis of their carrying amount because the useful life is different. So what we need to understand is if I have a 500 worth asset which has a useful life of 10 years, if I have to convert that into 1 year, then I can say I have 500 into 10, 5,000 worth of asset valid for 1 year. Okay, it's like calculating what is the value that I am generating from each of those assets. If I have to bring it down to 1 year, instead of using it for 10 years, if I am using all of that in 1 year, what is the value that I am getting? The weighted value what we call is 5,000. So you have to understand it this way. If I have 500, that is the value and the time that I will be using it for 10 years. In 1 year, if I have to use all the 10 years value, the weights that will come is 5,000. So 500 multiplied by 10, 5,000 is the carrying amount. Okay, same as 750 into 20 gives me 15,000, 1100 into 20 gives me 22,000. The reason we are doing this is to ensure that the allocation of corporate asset is based on not only the carrying amount but carrying amount and useful life. The reason being, maybe this asset, just for example, has carrying amount of 500 but it can be used only for 1 year. So if you just allocate it based on the carrying amount, the allocation will not be proper. So you have to calculate the weights, which is corporate asset, the carrying amount multiplied by the useful remaining useful life. So 500 into 10, 5,000, 15,000 and 22,000. In that ratio, you will allocate the corporate asset. Now, this 600, how we will allocate is, first we will calculate the total. 5,000, 15,000, 22,000, the total comes to 42,000, the total of this. Okay. Now, 600 has to be allocated in these three ratios. So what you will do is 600, I'll just show you the working here. 600 multiplied by 5,000 divided by 42,000, you get 71. 600 divided by 42,000 multiplied by 5,000, you get 71. 71 point something. 71.43. So we have rounded off to 72 because they said ignore the decimals, right? Or you can say 71 and do the calculation. So like this we have calculated 15,000 divided by 42,000 multiplied by 15,000 divided by 42,000 multiplied by 600. So like that we have allocated the 600 in 72, 214 and 314 basis to each of those assets. X can be allocated. Can we allocate Y? We cannot allocate Y. X can be allocated. Can we allocate Y? We cannot allocate Y. So the corporate asset X has been allocated. So carrying amount of those respective CGUs after allocation is 500 plus 72, 572. 500 plus 72, 572. Then 750 plus 214, like this we have done the allocation. Can we allocate the corporate asset Y? We cannot allocate the corporate asset Y, so we'll leave it as it is. Okay. Now, first what you will do is you have to test the impairment loss for each of the cash generating unit. So the question says the recoverable amount is 600, 900 and 1400. So 600, 900, 1400. Now 600, 900, 1400, if it is a recoverable amount, if the recoverable amount is less than the carrying amount, only then there is impairment. So here if you see 600, 900, 1400 as compared to 572, 964, 1414. So 572, 600, no impairment, ignore it. 964 to 900, yes. 1414 to 1400, yes. So there is an impairment. Now what is the impairment loss? 64 and 14. What is the impairment loss? 64 and 14. Now that impairment loss you have to allocate between the assets of CGU and the corporate asset. You have to allocate between assets of CGU and the corporate asset, because you have allocated corporate asset X to CGU B and CGU C. So what you have to do is, what is the carrying amount of corporate asset allocated? 214. What is the other amount? 750. So the allocation will be the total impairment 64 divided by 964 multiplied by 214. That gives me the allocation of corporate asset X, corporate asset allocated to X, and corporate asset allocated to B, which is X, and remaining will be allocated to other asset. Same way here, we have 1100 of other assets and 314 of corporate asset. In that ratio, you will allocate the impairment loss, right? So the total impairment loss is allocated in this way. Now, after the impairment loss has been allocated, we need to calculate revised carrying amount of each of the CGU. So CGU had an amount of 750 B. 750 is the amount for B. Impairment loss 50. 750 minus 50, we get 700. Same way, 1100 minus impairment loss of 11, we get 1089. And 14 and 3 is the impairment pertaining to X. So 600 minus 17, we get 583. Okay, so that is how we will allocate and calculate the impairment loss. Now, why we said cannot be allocated? So we'll consider it as a part of the overall company. Now, if you look at the overall company, the revised carrying amount comes to 3072 after impairment. Recoverable amount is 3200. Hence, there is no impairment. Okay, if at all, for example, if at all the carrying amount was, I'll just for our discussion sake, is 3000. If carrying amount was 3000, then in that case what we would have done, the impairment loss of 3072 minus 3072 minus 3000, the impairment loss of 72 would have been allocated to A, B, C, X and Y in the ratio of their respective carrying amount. If there was goodwill, we would have written off goodwill first. Okay. Second, for example, if they say here recoverable amount is 600. Okay. So because recoverable amount is 600, this is not impaired. So you will no longer impair that particular asset. You will no longer impair that particular asset. Here recoverable amount is 900 for including CG or including the corporate asset. So here also you will calculate how much will be the impairment that can be attributed to division B and division C based on their pro rata allocation of those assets. But generally this scenario will not come, because individually if you see, the recoverable amount here is 1400 plus 900 plus 600. So this itself is 2900, and you have other two assets also along with it, this 200 wala thing, and hence it may not be impaired. Now because ABC have already been impaired and ABC you have brought it to their respective recoverable amounts, then most likely the remaining impairment will go to the the corporate asset, which is corporate asset X and corporate asset Y. The question doesn't have sufficient information for us to do that, but the logic you need to follow is, if it can be allocated, first allocate it to A, B and C, calculate impairment, then take all the assets together and again calculate the impairment for the company as a whole. I hope it is clear. Okay. See, these are very lengthy questions. Will take time in the examination to read and practice, and a proper structure and a proper format is very important to complete it. Okay. Now, moving on, reversal of impairment loss. So earlier we said whenever we have an indication that there is an impairment and we calculate the impairment loss, subsequently it may be possible that there is no impairment and or the impairment has reversed, or maybe the recoverable amount has increased. Because the recoverable amount has increased, the impairment might have been reversed, right? So if there is a reversal of an impairment, how do we do that? That is what we need to understand. And one very important thing, goodwill related impairment shall not be reversed. So even if there is a recoverable amount, there is a reversal in the recoverable amount, goodwill related impairment will not be reversed. So impairment loss recognized in prior periods other than goodwill shall be reversed if and only if there has been a change in the estimates used to determine the asset's recoverable amount since the last impairment loss was recognized. So the change could have been fair value less cost to sell, that has improved, or the timing of the cash flow that has changed, or the fair value component whatever you have estimated that has changed. Based on that we will reverse the impairment. So, and also you need to see, like we have indicators of impairment, we have indicators of reversal of impairment. So if at all we see that, and if you see that okay, fair value less cost to dispose that has increased as compared to our previous estimate, or the recoverable amount has increased as compared to our previous estimate, then we can reverse the impairment. Goodwill impairment will not be reversed. Then sometimes what happens is, when we calculate impairment, we use value in use. We calculate value in use, and that value in use is calculated based on present value of cash flow. Now, as we reach closer to the end of the life, what will happen? The present value will increase because we are discounting the same for lesser number of periods. For example, if I have 10,000 to be received after 3 years, today if I discount it, I will discount it for 3 years. Next year if I discount it, I will discount it only for 2 years. So my present value will automatically increase. But just because the discounting factor has changed, or just because the number of years have changed, I should not say that there is a reversal of impairment, because the reversal of impairment or the change in the recoverable amount is purely attributable to passage of time. So just for example, here 1, 2, 3. Okay. And we are expecting cash flows only in the 3rd year. So present value will be 10,000 divided by, let's say our favorite discount rate, 10%. For 3 years, we get 7513. But in the next step when we calculate here, we'll say 10,000 divided by 1.1 to the power of 2. So it has become 8264. Now this increase is not called reversal, because my estimate of cash flow has not changed. This is purely because of unwinding of discount, and hence we will not consider it to be reversal of impairment. I hope it is clear. Now, how do we account for impairment reversals? See, when there was an impairment, we said if it is not a revalued asset, we will take it to P&L. We'll take it to P&L, correct? Now here also, you will reverse the impairment loss by increasing the asset value and crediting the P&L. Now, we'll take one example here to understand how do we, reverse that particular amount. Let me just share the screen. So, say for example, carrying amount was 10,000. Recoverable amount was 8,000. So, we said impairment loss is 10,000 minus 8,000, which is 2,000. That's the first year. Now, subsequently what we do, let us say in second year, carrying amount is, so 8,000 is the recoverable amount, and assume for a moment that the asset has a 10-year useful life. Remaining useful life is 10 years. So 8,000 divided by 10, 8,000 minus 8,000 divided by 10, you get 7,200. 7,200. So that is the carrying amount. And let us say recoverable amount, we calculated that recoverable amount will be 9,200. Okay, carrying amount is 7,200. Now the recoverable amount is 9,200. If you see the difference, you will see that the difference is 2,000. Now, this 2,000 of impairment reversal, we should recognize it in P&L subject to one condition. What is that condition? See, here we said 2,000 is the impairment loss. We recognize it in P&L. Second year we are saying carrying amount is 7,200, recoverable amount is 9,200, 2,000 is reversal of impairment, which is not correct. So what should we do is, we should see if there was no impairment. If there was no impairment, then what would have been the carrying amount? If there was no impairment, then what would have been the carrying amount? The carrying amount would have been, if no impairment, it would have been 10,000 divided by 10,000 minus 10,000 divided by 10, that is 9,000. If there was no impairment, the carrying amount would have been 9,000. So what the standard says is, you cannot bring back the asset at an amount higher than the carrying amount without impairment. So you have to calculate carrying amount without impairment, and then you have to see that maximum amount you can reverse should be to the extent of carrying amount without impairment. So here you will not say recoverable amount 9,200, you can at the most bring it to 9,000. So 1,800 will be the reversal of impairment. Is this concept clear? Now, this is the case when it is without revaluation. If it is without revaluation, this is how you will do. If there is revaluation and there is reversal of impairment, then you will consider the treatment as given by Index 16 or Index 38 as the case may be, or Index 40 as the case may be, where Index 40 revaluation is not permissible. So Index 16 and Index 38 as the case may be, you will consider as to be a revaluation gain. The way you treat the revaluation gain or revaluation increase, you will consider the same way the reversal for the individual asset. Then subsequently, when we value that, subsequently when we calculate the depreciation and all of that, that also will be based on the revised amount. Now, continuing with the same question which I had shared yesterday, the LR limited question. Now, till here we have understood sometime back that the carrying amount is 489,770 and 310,230. Then we calculated the depreciation. Carrying amount on 31st March of 19 is 4,01,000 and 2,65,000 as per this calculation. So carrying amount minus residual value, depreciation when you calculate, you get 4,01,000 and 2,65,000. So the total is 41,265 and inventory is 2 lakhs. Total carrying amount of the CGU is 867. Recoverable amount is 11 lakhs. First year, recoverable amount was lesser. We said we have to, do the impairment. Second year, we are saying that the total carrying amount of CGU is 867. Recoverable amount is 11 lakhs. So if recoverable amount is 11 lakhs, means there is a potential reversal in impairment. Now, whenever you have this kind of question, you need to cross check that what would be the carrying amount without impairment, meaning to say 525 and 350 was their respective carrying amount before impairment. For 525 and 350 was their carrying amount before impairment. Then the depreciation is 95,000 and 50,000 per year. So what you will do is you will calculate 525 minus 95, 525 minus 95, which is the carrying amount 430. 430 here and 3 lakhs here. That is without impairment. That is without impairment, what would have been the carrying amount. Then carrying amount after impairment is 401 and 265. Now what we say is maximum it can be 284 and 34,088, which can be reversed. That is, the maximum amount that you can reverse will be the difference between carrying amount without impairment and carrying amount after impairment. So 28 plus 34, total reversal possible is 62,272. Here we have calculated 232,272. But can we reverse the entire 232,272? We cannot. We have to check what would be the carrying amount after impairment and carrying amount without impairment. That is what you have to compare. And maximum reversal that is possible is 62,272. So you will reverse maximum 28,184 for the first machine and 34,088 for the second machine. So what about the difference? That difference may be reversal of goodwill. And do we recognize that? We do not recognize that. Okay. So that is where we will not recognize and we will reverse the impairment only to the extent of 62 to 72. So that restriction you need to put. When you are looking at reversal, that restriction you need to put. Now, whenever we have cash generating unit and if there is a reversal, that has to be done on a pro rata basis to the respective asset. So like we allocate impairment loss on a pro rata basis, same way reversal of CGU we should do it on the basis of pro rata of their carrying amount. So whatever is the carrying amount, on that basis we will reverse the impairment. Now one very important thing that you need to keep in mind here is whenever we are reversing impairment, the asset should not be stated above its recoverable amount. Second, above the amount that it would have been without impairment. So always calculate what is the amount without impairment. It cannot go more than that. So that is one important check we need to keep in mind when we are calculating impairment reversals. So the increased carrying amount of an asset shall not exceed the carrying amount that would have been determined had no impairment loss been recognized. And maximum impairment loss reversal is impairment loss previously recognized. So you cannot say that, oh no, my asset has gone up by a higher amount, I will say there is an impairment gain. There is no concept for impairment gain. If you want to do that, take it to the revaluation model as per Ind AS 16 or Ind AS 38. Then increase in carrying amount of individual assets in a CGU shall not be increased above the lower of its recoverable amount, means you cannot state it above the recoverable amount, or the carrying amount if impairment has not been recognized earlier. Okay. Now this is very, very important non-controlling interest related goodwill impairment testing. Okay. Now I will take up a question and I will solve this for you, right? I'll again put out a detailed video. Those of you who want to understand the detailed concepts, the logic behind that, I'll definitely put out a separate video on this. You can have a look at that alongside. But here we'll be looking at a question on non-controlling interest and how do we calculate the reversal when there is a non-controlling interest and goodwill. Because whenever there is consolidation, we have goodwill. Now that goodwill may be related to only the parent, or it may be related to the non-controlling interest as well. Now what do I mean by that? I'll just explain it to you with a small example. Any questions, do let me know. If downward revaluation had been done twice in the past, see, one thing what you have to understand is, whenever you are using Ind AS 36, whenever you are bringing some asset to Ind AS 36, calculate the amount as per Ind AS 16. Calculate amount as per Ind AS 16. If you are saying downward revaluation, then you have to consider revaluation. If you are saying 2 times impairment has happened, then originally you see what was the amount without impairment and calculate what would have been the amount with impairment and without impairment. Now, if you are following the revaluation model, the very simple thing is, any reversal of impairment is like a revaluation gain, and you will treat it as if it is a revaluation gain. So there is no confusion on that aspect. If you are talking about revaluation, earlier also revaluation downward, take it to P&L. Then again revaluation downward, P&L. Impairment loss, P&L. Okay, some of you may have a doubt, sir, if I'm already doing it at revaluation amount, why is there an impairment possible? Because revaluation is done at fair value. Revaluation impairment is done as fair value less cost to sell. So that is why there can be a difference. Now, once I have done revaluation, if I have reduced the asset amount based on revaluation, subsequently when I come to impairment, I'll compare that revalued amount with the recoverable amount. Now, subsequently, if there is a reversal of that impairment loss, what you will do is increase in that will be considered as a revaluation gain. So you will do the reversal and again apply revaluation model under Ind AS 16 to increase the amount further. Now, the specific case of goodwill, what happens is what we are discussing here. Let us say there is a parent. There is a parent. System one step, just a second. Let's say there is a parent and there is a subsidiary. Parent acquired 80% of the subsidiary. Parent acquired 80% of the subsidiary. Now what happens is, we'll understand this in Ind AS 103 in more detail. What happens is, we will calculate goodwill. We will calculate goodwill based on fair value of consideration, NCI, which is the non-controlling interest. Now, non-controlling interest can be at fair value or proportionate share of net assets. Okay. So, fair value of consideration, let us say 1000. Here also it will be 1000. NCI can be at fair value, or we call something as proportionate share in net assets. Proportionate share in net assets. Please understand this logic very, very carefully, because that will help you understand. So, we will understand goodwill calculation and all of that subsequently also. But this is very important for you to understand what is the fair value method and what is the proportionate share in net asset method. NCI fair value, let us say, is 200. NCI fair value, let us say, is 200. This total comes to 1000 plus 200, 1200. This is what I call is what we have paid, what owners have paid for the business. Okay? And let us say fair value of net assets. Fair value of net assets is 800. Fair value of net assets is 800. Goodwill will be 1200 minus 800, 400. Okay. Now, if we follow the proportionate share in net asset method, fair value of net asset is 800 into 20%. That gives me 160. So the total becomes 1160. Fair value of net assets is 800 and the goodwill becomes 360. Now what you need to understand is, when we follow the fair value of NCI, the goodwill pertaining to that is also considered in consolidation. So here the goodwill 400 represents goodwill attributable to the parent and goodwill attributable to the non-controlling interest. Here if you see, this is only goodwill that is pertaining to the parent. The non-controlling interest goodwill does not get captured here, right? Now, this particular aspect, if you understand that when you're following the fair value method, the goodwill of the NCI also gets attributed. If you're following proportionate share in net asset method, only parent's goodwill is reflected. If this understanding is clear, then we can move to the actual aspect of determining the impact of goodwill impairment testing in non-controlling interest. So now, as I told you, if non-controlling interest is measured at acquisition date fair value, means NCI share of goodwill is also recognized in consolidated financial statements. But if you are following the proportionate interest in net identifiable asset, then the goodwill pertaining to the NCI is not recognized in the parent's financial statement. Now, when I am testing a subsidiary for impairment, then what happens is, the subsidiary being my CGU in the consolidated financial statement, the CGU, when I say the recoverable amount of the CGU, will include goodwill, but under this particular proportionate interest in net identifiable asset method, the goodwill is not captured in net assets. The goodwill is not captured in the financial statements. The goodwill is not reflected in the financial statements. Whose goodwill? The subsidiary's goodwill, the NCI's goodwill. See, under fair value method, I have goodwill of both parent and NCI, but in net asset method, I don't have goodwill of NCI. But if I'm looking at the business as a whole, that includes 100% of the goodwill. So in that case, what we have to do is what we call gross up the goodwill to include goodwill attributable to non-controlling interest, and then check for the impairment. Now this is better understood by an example. I have explained you the logic. Now I'll take an example and we will see how does this happen. This question also you should mark it as important because may be tested and you can score well. Once you understand how it is done, the scoring part becomes very, very easy. If you have any doubt in the logic part, why we are grossing up, please let me know. Otherwise, we will be good to solve this particular question. A Limited acquires 80% shares in subsidiary for 3200,000. So we'll just say 3200. At the date of acquisition, B Limited's identifiable net assets is 3000. A elects to measure NCI at proportionate share of net identifiable asset. It recognizes, so the purchase consideration 3200. Identifiable net asset is 3000. So 3000 into 20%, this becomes 600. 3200 plus 600, 3800. Net assets 3000. Goodwill 800. At the end of next financial year, B Limited's carrying amount is reduced to 2700. So B Limited's carrying amount is now come down to 2700. The carrying amount is 2700. Excluding goodwill, it is come down to 2700. Recoverable amount is 2000 in one case, 2800 in another case. Calculate the impairment loss allocable to parent and non-controlling interest in both the cases. Now here, what we need to understand is the goodwill that is calculated, that goodwill pertains to only the parent. That goodwill pertains to only the parent, and that represents 80%. So what you have to do is, we have to calculate other assets is given to be how much? 2700. Goodwill for parent is 800. For NCI, we do not have the number. For NCI, we do not have the number. We need to put it up. So 800 is representing 80%. So 20% would be how much? 20% would be 200. So my total goodwill becomes 1000. And the total of this is 3700. That is my carrying amount. That is my carrying amount, including goodwill. Right. Now, what does the question say? The question says that the recoverable amount in the first case is 2000. The recoverable amount in the first case is 2000. So recoverable amount is 2000. Now, if a recoverable amount is 2000, carrying amount is 3700, there is a loss. 3700 minus 2000, loss of 1700. Impairment loss of 1700. Now, the impairment loss of 1700 should be allocated to first goodwill, then to other assets. First to goodwill, then to other assets. Now, goodwill is how much? Goodwill is 1000. So, this goodwill takes 1000. Other assets take 700. Okay. Now, in this 1000 also, I have recognized only 800. I have recognized only 800. I have not recognized 200. So, goodwill impairment, I will say in 800 in the consolidated financial statement and 700 for other assets. Goodwill 800 for the consolidated financial statement, only the parent share, because this I have not even included in my calculation in the balance sheet. Why am I doing all of this? I am including the 200 for notionally calculating the impairment loss. Now, if I have not recognized 200 of NCI's goodwill, I cannot do an impairment of that. So what I will impair? I will impair only this 800. So 800 of goodwill gets impaired here and 700 of other assets get impaired here. Okay. Now, out of the 700 of other assets that is getting impaired, out of the 700 assets that is getting impaired, out of this 80% belongs to parents. So you will take it to what we call as the retained earnings, and 20% belongs to NCI. That is what we will take it to the NCI interest. So what we will do is, in the summary, 800 we will remove from parents' goodwill. 800 will remove from parents' goodwill. Then 700 we have to remove from other assets. The impact on P&L will be only 80% because that is what is my consolidated retained earnings, and 140 pertains to non-controlling interest. So I will reduce 140 from non-controlling interest balance. Okay. Now, in the second scenario where the recoverable amount is 2000, how much is the recoverable amount? 2800. If my recoverable amount is 2800 and my impairment loss works out to 3700 minus 2800, which is 900. My impairment loss works out to 900. Now, out of this 900, first I have to knock off goodwill. Now, goodwill has a value of 1000. So, entire 900 pertains to goodwill. Out of this, 80% is for parent and balance 120 is for NCI. Now, that 120 I have not recognized, so I will ignore. So, what I will do, 720 impairment loss I will recognize in goodwill. So, carrying amount will be goodwill 800 minus 720 will be the goodwill's carrying amount, and other assets carrying amount will remain the same. So, why same? Because other assets are not impaired. Entire impairment is allocable to goodwill. Sir, but why did we not write off entire 900? The reason being, 800 is the amount that we have recognized in the consolidated balance sheet. 900 is the total impairment loss. Out of that, 80% is only recognized, so we'll write off only 80%. Balance 20%, it is not recognized, so we will not write off. So goodwill balance will be 80, and NCI other asset balance will be 2700, and the 720 of impairment loss will be taken to the consolidated P&L. Any questions? Any questions? Okay, no questions. This, please mark it as important for revision. So whatever questions we have covered, right, the 3 questions that we covered today, please ensure you go through it once before your examinations. They may sound simple, they may look like easy, but if you miss a step, see, these kind of questions are standard questions, and if you know the steps, you will score 8 out of 8 or 10 out of 10. There is no chance that you will miss out on any specific question on that, or marks on that aspect. Disclosures you can run through on your own, and I have covered 2-3 important questions. One question's full detail I have already shared with you. So we'll do one more question on the cash flow. Pretty comprehensive question. It's also very, very important. E Limited owns a machine used in manufacturing of steel wheels, which are sold directly to a major car manufacturers. The machine was purchased on 1st of April of year 1 at a cost of 5 lakhs through vendor financing arrangement, on which interest is being charged at 10% per annum. Now, financing related cash flows we should not consider. During the year ended 31st March, he sold 10,000 steering wheels at a selling price of rupees 190 per wheel. So, they sold 10,000. The most recent financing budget approved by management, covering the period from 1st April of year 3 to 31st March of year 8, including the company indicated that the company expects to sell each steering wheel for rupees 200 during year 3-4. The price in later years are in line with the forecasted inflation of 3%. So you are saying you will, right now you are selling at 200. Every year it will go by 3%. So 3% means 200 at 3%, 206. Then again another 3%. So like that you continue to increase. Now don't think 6 rupees per year. 200 into 3%, 206. 206 into 3%, add to that and continue. During the year ended 31st March, E Limited expects to sell 10,000 steering wheels. 10,000 steering wheels. The number of forecast is to increase by 5% each year. So again here 5% every year it will increase. So the quantity also will increase by 5% each year. This is more like a financial management type of a question. E Limited estimates that steering wheel cost 160 to manufacture, which includes 110 variable cost, 30 fixed overheads, and 20 of transport cost. Costs are expected to rise by 1% during year 4-5, then by 2% per annum. So cost also increase by 1% and 2%. The machine will be subject to regular maintenance costing 50,000. Now, this is this is something which will happen. There will be an outflow, so that 50,000 of outflow should be considered. In year 3, year 4, the company expects to invest in new technology costing 1 lakh. The technology will reduce the variable cost of manufacturing each steering wheel and the share of fixed overhead from 30 to 15, subject to availability of technology, which is still under development. Now, here is where you have to be careful. Here, what you need to understand is this is an expected. Is there a commitment? No, sir, there is no commitment. If there is no commitment, then you will not consider that particular outflow. And the related reduction also you will not consider. Okay, so this is a distractor. If you think that no, they have said we'll reduce the cost, let me include that in the budget, then gone. Okay, then E limited is depreciating the machine using straight line method over the machine's 10 years useful life. The current estimate based on similar assets that have reached the end of the useful life from the end of the useful life, disposal proceeds are 80,000. X E limited expects to dispose the machine at the end of 8th year. Now, whatever you are disposing 80,000, that you should consider as an inflow. The pre-tax discount rate is 8%, which reflects the market assessment of time value of money and risk associated with the asset. Assuming a tax rate of 30%, what is the value in use in accordance with Ind AS 36? Now here, a few things that you have to keep in mind is that, so let's put down the solution. Just a moment, let me put down the solution. Now, if you look at the way you have to present the solution or the structure of your approach, what are the units sold? 10,000, increasing by 5% each year. Okay, then selling price increasing by 3% each year. Then you can get the cash inflows. Disposal proceeds should be added. Tax should not be considered. Then financing element should not be considered. Manufacturing cost 160. It is expected to increase by 1% in the first year and then 2% in each of the subsequent years. So that also number I have put. Then total cost into total number of units. Maintenance 50,000 in between you should consider. Then you will get the net cash flow. Present value at 8%. Present value of cash flows and what is the value in use. So this gives us the value in use for this particular machine. Now 2-3 things that I told you that you have to keep in mind. Number 1, tax, ignore. Number 2, future expected cost, ignore. Sir, but why did we consider maintenance? See, maintenance is a routine thing which you have to incur. But that new technology we have not yet committed to, so you should not consider that new technology. And then calculate the present value of cash flows. Any questions in this? So we took more time in Ind AS 36 as estimated. So I'll put it down below here. Ind AS 105 will cover it subsequently because I want to focus on these very important topics that we are doing. So we'll do Ind AS 105 subsequently whenever time permits. We'll be able to complete that. Next focus of the next week will be next week and the week after that will be your financial instruments, business combination and consolidation. Very, very important, heavy and very important from exam point of view. If you cover 116, 115, financial instrument and business combination and consolidation, both of them actually should be a single chapter in my view. If you cover this, 50-55 marks is covered for you. 50-55 marks is covered for you. And with that 50-55 marks, if you are able to score 30-35 also, a lot of burden gets off. And then we have simple bonus questions which are very, very easy for us to solve. Repeated questions which we have that we can do. Now, please complete the questions. Calculations, impairment looks easy, but I'll tell you it is not easy. I was actually stuck in one of the interviews because of an impairment related question. Yes, there are multiple factors. So please go back, complete the illustrations. The important illustrations that I've discussed, please mark them for your last day revision before the examinations. I'll see you on Monday, and have a nice day. Thank you.